Welcome back to another monthly commentary video. I hope you all are having a great summer. Today is Tuesday, July 30th, so we are going to recap the month of July, which I've dubbed the Great Reversal, or the Big Reversal, I should say. So everything we talked about in June basically flip-flopped, and we highlighted some of the disconnect between U.S. large caps and small caps that had a major flip within the month of July. We'll talk about that. We're going to talk about the starting point for U.S. large caps. Many people are saying they are overvalued and what that could mean for future returns. Also, how eerily calm U.S. stocks have been this year. Up until last week, we had not seen a 2% decline in the S&P 500. Of course, we got that last week, but it was like 360 days since we saw a 2% correction. And then we're going to check in on sentiment and what the Fed could do later this fall. So thanks for watching. Let's get into the slides. Per usual, this is a monthly recap. And again, we're 1 day short, 1.5 days short of the end of the month. But we've highlighted a few of the important asset classes to our clients, starting with the leader thus far. Small cap, U.S. small cap stocks up about 10.5% in the month of July. Just a huge breakout. There's many theories why small cap has broken out. Many people point to the Fed's intention to potentially cut later this fall. Smaller companies have more floating rate debt, which means if rates are higher and rates are moving higher, their borrowing cost, their cost of capital goes up. Conversely, as rates fall, as borrowing costs go down, the cost of capital for smaller companies goes down, thus providing a tailwind that could boost profit margins, free up other capital for other projects. So small caps tend to be more sensitive to interest rate movements than larger companies. Larger companies have access to debt markets. Many large companies locked in borrowing costs when rates were at zero, borrowing costs were low, and it's much more fixed. So large companies in general are less sensitive to interest rate movements. So that's small cap. Bitcoin, pretty solid month, up about 5%. You can see some of the wild swings here. In early July, Bitcoin was down about 10%, snapped back to up 8%, 8.5% at its peak, and settled back down at about 5%. DIO, that's the Dow Jones average. Gold, another solid month. Gold has been a stellar performer this year. Look at bonds. These are intermediate term treasuries performing nicely in the month. International developed, short-term treasuries. You can see the S&P is down actually on the month, followed by emerging markets. So all in all, a lot of these equity asset classes, including bonds, to see some breadth, some leadership change. Meaning it's not just all U.S. large cap, the S&P driven by 7 companies, but some of these other asset classes which have been out of favor starting to behave better in July. Okay, let's look at the valuations of the S&P 500. So this is as of the end of June, but this story really doesn't change if we add July. And by any metric, so there's several different metrics to measure talking about forward price to earnings, which basically measures how expensive stocks are relative to forward earnings expectations, to a more broader measure. The Shiller PE essentially looks at the previous 10 years of earnings and applies a multiple to current levels of the S&P. So anywhere you look, so latest, and the higher the number means the more fully or overvalued the S&P is. When you compare latest measures to the 30-year average, we're basically technically overvalued regardless of what you're looking at here. Price to book, price to cash flow, Shiller PE, forward PE. You can see the 30-year average is about 16.7 for forward PE, and we're right around 21 as of the end of July. But again, as we've said in our podcast, through our blog, just because something is expensive doesn't mean it's automatically going to get cheap or, in this case, revert back to the average. What's expensive can stay expensive. What's cheap can stay cheap. However, when you look at the longer term, your current starting point, meaning how fully valued something is, there is evidence to suggest that can explain future returns. So looking at that same forward PE from the last slide of 21 times, we can look based on a forward PE ratio of 21 times earnings, what future one-year returns are for the S&P. So this is our starting point. This is the average subsequent one-year returns for the S&P that's trading at a PE of 21, and it's basically zero. So down here is PE. You can see 21 would fall right here. So this red square showcases where we're at given our starting level and what future one-year returns have been over the last 25-ish years. You can see the wider these dots, the more wild the dispersion is, meaning regardless of the S&P level, one-year returns can be quite noisy. You can see, in general, the further we get out here on the right with PE, the rarer return cluster that we see here. So it's not uncommon for equities to be rich and future one-year returns to be zero or actually negative. But there's also evidence to suggest that, again, what's expensive can get even more expensive. So one-year returns, and I think this resonates with people and makes sense, are typically all over the map. Risk graph, much more meaningful, much tighter cluster of these dots. So forward PE, again, we have 21, and subsequent 5-year annualized returns. So we're looking current levels. What are the average 5-year annualized returns for the S&P 500? You can see this dispersion is much tighter, which is good. It means the data is much more meaningful. It's a better fit to this line. But you can see forward 5-year returns are in the low single digits. This looks like about 3% for me. But you can see future returns are in the low single digits. This looks like roughly 3% a year. So forward 5-year returns have averaged 3% a year based on a starting PE of 21. I'm not saying this is going to happen, but there is, again, evidence to suggest future returns are definitely lower the more fully valued we are today. Conversely, if you look at a PE of 11 or 12 or 13 or 14, you can see future returns tend to be pretty good, although there are some instances where they're not so good. So again, terrible timing tool, but I feel like the 5-year data set, future annualized returns are much more meaningful than the 1 year. And again, the more fully valued we are, the potential is there for lower future returns. Okay, switching to volatility. So one thing that kind of makes me nervous is this has been a pretty good year and volatility has been non-existent. So despite what people will tell you, despite what most consumers think, despite what you'll see on financial TV or financial media, this has been a pretty calm year for U.S. stocks. So what this is the daily returns for the S&P 500 by year since 2021. So 2020 was a COVID year. Look at this wide dispersion of returns, right? That was a crazy year. The market was down 30% in like 30 days, bounced back just as quickly the second half of the year. 2021, extremely docile year. We only had a handful of days that saw the S&P decline by 2%. Most of it was small positive returns, which are characteristics of a bull market. 2022, again, was a wild year. This is kind of skewed to the left. The S&P was down about 20%. And then 2023 was a pretty good year as well and was rather calm. See how tight these circles are. And 2024 has been even more docile yet. So last week, we had the first 2% decline. So if we updated this as of today, there would be one dot here. But you can see when comparing to the last couple of years, this dispersion of circles is narrower and tighter than any other year since 2020. And it's really not even close. So this has been a really good year for the S&P 500 with limited downside movement of stocks, which again doesn't really reconcile with how people are speaking. Everyone's talking about the election and a recession and inflation. and what the Fed's doing and geopolitical risk. But stocks tend to shrug off a lot of that, and it's been quite calm, okay? Kind of in the same spirit, I like to revisit this graph every couple months. So what this is the average intra-year drawdown, average decline for the S&P 500 over the last 44-ish years. Okay, so this is where we're at. Again, this limited downside. If the average decline is 14% within a given calendar year, we've only had a 5% decline. That would support the last slide. It's been a pretty calm year. And I chuckle, there's all these Wall Street talking heads that talk about what happens next. One of the most infamous bears, meaning a pessimist, came out and said the S&P is going to have a 10% correction between now and the end of the year. Well, when you look at the data, that's actually quite normal. So stocks, again, decline on average 14% a year over the last 44 years. We have not had that yet. That's like saying the sun is going to come up in a Portland August. So that's not really profound. He's trying to sound smart, but when you look at the data and empirical evidence, that's actually quite normal. Intra-year declines are quite normal for the S&P 500. Okay, so last month we highlighted the historical gap between U.S. large cap performance and small cap performance. And if you've been paying attention to our content, it's been U.S. large caps driven by a handful of tech companies, and everything else has underperformed on the equity side. Something funny happened in the month of July. That all flipped, and you can see it here where small caps had a ravenous rally. A lot of folks point to potential rate cut in September that the Fed has been talking about, and we'll get to that in a minute. Also, the current starting point, which I touched on as well, U.S. large caps are expensive by historical standards. The Russell 2000, which is a measure of U.S. small companies, is very cheap by historical standards. There was a massive divergence between U.S. large cap and U.S. small cap, and many folks, including us, thought it was only a matter of time for this to flip. It just so happens it flipped in the month of July, and you can see this gap was really wide throughout most of the year, and it's quite narrow now. So again, back to my previous comments, it's not unusual for equity asset classes that have been out of favor to snap back, and it happens rather quickly, especially for a volatile asset class like small caps. And then on the flip side, it's not uncommon for what's been working to sell off as investors look at the future opportunity set and make calculated bets on what they think is going to outperform during the next phase of the cycle. So this is kind of a testament to why performance chasing can be dangerous. I know the AI theme has gotten a lot of the headlines and attention, but many smart investors are starting to look at other fairly valued asset classes that could perform well during a lower rate environment or the Fed cutting rates. I'm going to be writing a blog post about this, about future S&P returns or future large cap returns during rate cutting campaigns and what other asset classes might be attractive when rates start to go down. So look forward to writing that. Okay, one of our favorite measures, part of our rules, I talk a lot about our portfolio rules, our portfolio management framework for making decisions. This is one of the inputs, and this is very interesting because it flies counter to how most investors think. So what this is consumer sentiment in subsequent one-year S&P returns. So every month there's various consumer sentiment surveys that basically capture how U.S. consumers are feeling about the economy, are feeling about markets. What's interesting about this, and this goes back to 1971 through June of 2024, is as sentiment peaks, and the sentiment peaks are above this dotted line here. So anytime you see a blue dot above this dotted line, that's a sentiment peak. And basically what we're doing is charting future S&P performance for 1 year from each of these sentiment peaks. Okay, so there's 9 sentiment peaks since 1971. You can see in blue here the future 1 year S&P return from these sentiment peaks. This little box here summarizes it nicely. So each sentiment peak the average forward S&P return is about 3.5%. Okay, so each time we get a peak, the average forward S&P return is about 3.5%. Now the sentiment troughs. So this is when people are feeling really bad. The economy's in a recession. You can see the recessions are marked by these gray columns here. Maybe there's been a market sell-off. Maybe there's been a geopolitical event. From these sentiment troughs, we're capturing future one-year S&P performance. Okay? And that's summarized here. So when people are feeling the best, a sentiment peak, future returns are quite low, 3.5%. When people are feeling horrible, we just got through a recession, we're about to go into a recession, we're in a recession, future returns are outstanding, about 24%. So this is why we pay close attention to sentiment. Many people want to buy more stocks when things are going well and shun stocks when things are going bad. With all the technology advances and the algorithmic trading and the hedge funds and the smart money out there, I think a really good thing to pay attention to is sentiment. And it doesn't have to be an official study. You can talk to your 5 best closest friends or family, and you'll get a pretty good gauge of how people are feeling. You can go on social media too. And I'm telling you, it's a really good input to at least pay attention to. When people are greedy, might be time to pump the brakes. When people are fearful, might be time to increase your equity exposure or put some cash to work. That's worked pretty well throughout history, or at least since 1971, but this does also go back as far as you want and is a pretty good predictor for future S&P performance, how people are currently feeling. Okay, lastly, this is the probability that the Fed is going to cut interest rates in September. And you can see the current target rate, the Fed's fund rate, which is just short-term rates, is about 5.25 to 5.5%. There's a 90% plus this 10%. The Fed is going to cut rates at least by 0.25%, so 0.25%. Some people even think there's a 10% chance the Fed could cut by 0.5%. But you take these probabilities together, and it's virtually 100% certain that the Fed is going to cut rates in September. I think they've been telegraphing this with their words, with their speeches. And the only thing that could derail this is if we get a hot inflation report, like super hot, between now and September when they're set to make this decision. But again, look for a future blog post, because there's mixed theories on what happens to stocks when the Fed starts to cut rates. What we would ultimately like to see is a slow, measured campaign of rate cuts. That's a sign the Fed has threaded the needle between managing inflation, keeping full employment, not rocketing the economy into a recession, and not upsetting financial markets. Okay, so again, the Fed has a dual mandate to keep inflation around that 2% target while keeping people employed. The flip side to this is if the Fed cuts rates very quickly, that's usually not a good sign. That's a sign of an economic event. So a recession, a slowdown in activity, maybe even a market crash. So you want to see rates going down slowly. You want to see inflation going down slowly. If we get a rapid rate cut, or the longer end of the yield curve, like the longer end meaning 10 to 30 years, really goes down quickly, yields go down quickly, that's usually a sign of economic stress. So again, it's a balance. But again, inflation is headed in the right direction. As long as we continue to see progress, you should see a rate cut in September. And what this is real people, smart money, voting with their wallets with what they think happens next. So this is usually a pretty good thing to pay attention to, and this is the Fed futures market. Okay, that's it for the month of July. If you're watching this on Facebook, give us a like. That's really helpful for the channel. If you have any questions or want us to cover any topics, shoot us a note at insight@pureportfolios.com. And don't be afraid to share this with your friends if you find it helpful. Thanks for watching. We'll see you next month.